Good morning, ladies and gentlemen. Thank you for taking the time to join us today for our second session, our second webinar for you, our valued KZN client. Our first being the economic overview and update we had on Tuesday. My name is Ketwe Gunene, the organizer, and today's focus and topic is tying up the loose ends in your estate post-lockdown. Our two speakers today to put us at ease in these uncertain times of COVID-19 are Errol Meyer, who holds the position of Advisory Propositions Legal Specialist here at Standard Bank. And alongside him, we've got Candice Murray, the Legal Marketing Specialist in Sales Enablement at Liberty Life. The session should be about 45 minutes to an hour or so, and we'll take questions at the end. So to type in your questions or to send us your questions, you can type it up in the questions box on the panel on your screen. That should be on your right-hand side, that panel. And then we'll address the questions at the end of the session so that we don't disturb the presenters. I'll now hand over to our two speakers to take us through the presentation. Thank you and good luck, Errol and Candice.
Okay,
hello,
thank
Errol.
you, Ketiwe. Yes, Ketiwe, you can hear me?
Yes, we can. Over to you.
All right, thanks, Ketiwe. Well, good morning to all attendees and welcome to our webinar. In this webinar, the focus is going to be the truth. Let's talk about the truth and how we're going to go about estate and financial planning. So I'm going to talk about fundamental principles. What are these things that one should take into consideration given now the times that we find ourselves? And then Candice is going to come in at the end and she's going to slap on it. She will give some practical solutions as to how to go about. So you see, this presentation is not going to be about, oh, what I should do. We're going to try and focus on how should I actually do that? And we're going to make use of practical applications. So where do we start? I always find it useful to say, define exactly what it is that you're meaning. So when you talk about planning, what do you mean by planning? How do you see it and how you define it? And that then will give us context as to what estate planning and financial planning is all about. So what is planning? So one person said, which resonates well with me, and said, planning is bringing the future into the present so that you can do something about it now. Now, that is a very powerful statement, and to my mind, the crux and the cornerstone of any planning, which includes estate and financial planning. Now, the forerunner of this statement is it calls for action. The question is, what type of action? Now, let's analyze that first. When we look at the time frame, which is life, you're going to look at things that happened in the past. You're going to look at things that is in the present right now, which is a very brief moment, and then you're going to look into the future. Now, when you look at these three things, you'll find that the mind is a wonderful thing. It will harass you with what happened in the past, and it will give you certain signals. And if that is not enough, the mind will jump forward and it'll look into the future and what can go wrong. The thing is, there is nothing you can do about the past and the future. It's only in the present, which is now, that action can be taken. So all the decisions that you are making, you're going to focus on exactly what is happening now. So what people obviously often do is they say, I have to do something. And then they will start moving chess pieces around on the chessboard without knowing what it is. You need a clear strategy. And this is what I'd like to focus on today. What are those fundamentals? Because it is a truth that all of us may have different solutions. And the issue is, we should all have the same questions. It's not about the solutions. So let's focus on what are the type of questions that we should all agree on, which is the truth. And from then we can formulate scenarios. And once we formulated scenarios, only then we can act. Well, that is the philosophy behind planning, which is bringing the future into the present. Now, when you look at estate planning and you look at financial planning, which are the two most fundamental movers out there that we should look at? And there are only two. Now, when we look at COVID, both those two things are happening at the moment, because what we are talking about is the protection of health and wealth. And those two go hand in hand. When you look at the discussions taking place, we've got to lift the lockdown. It's a constant debate about the health people dying and about the business confidence and the business market that is suffering. And how do we balance it so it's a balancing act? And exactly the same principle applies when it comes to our finances. Now, when you look at COVID has killed 283,000 people in the world, and it has crashed the economies. This morning, listening to Kevin Lings again, talking about people, we're going into recession. Some companies or some countries were already in a recession, South Africa included, but now it's going to become worse. So this is the reality. The reality is that we've got to get 7 billion, because there's about 7 billion, 8 billion people in the world. They all need to get vaccines. That is a challenge. Now, Bill Gates warned us a long time ago. The global trends showed that 5 years ago, an infectious disease pandemic poses a greater threat to the world than nuclear war. Well, there we go. This is what we have. But then what we hear out there, we hear about the conspiracy theorists. Someone developed it. And not to talk about the social media specialists. Now, being isolated, we all are prone to all of these things being said. And then on top of it, we get fake news. And people with fake news also have an agenda. And that agenda is to promote their cause, to sway public opinion, and some just for advertising time in order to make a profit. And all of these things is doing something to us. It is driving our emotional behaviors. And this is where the danger is. Now, if you go billions of years, the emotional side was where decisions were taken because to survive, fear was a very important thing. Because when there was a fear, you reacted, you had to run away or defend yourself. The problem is that today, these emotions can override the logic. So what is the answer? The answer is to get back to the logic. And this is exactly what we're going to explain today. What is the logic? What is the fundamentals? Let's forget about all the emotional drivers. Let's look at the present, because it is clear that people today, they would lie awake at night, not worried about their investments and maybe worried about their work, but the real worry is, will I be okay? And this is where financial planning comes in. So, what is it that we should focus on? Because the concept of focus, together coupled with acting in the present, is the logic. So let's build on the logic. So let's make it simple. What is the logic? The logic is the why. Why am I doing this? Why am I laying awake at night? Why am I concerned about my pension fund and my retirement funds and the value of my house? It's because, am I going to be okay? So in life, we make use of the wealth quadrant. And briefly, just to position it, the wealth quadrant is the balancing act in life. And this is about balancing your values and giving purpose to the money that we use in order to acquire some or to give effect to those values that we have. So there on the left-hand side, you will see this is the asset side of your balance sheet in life. It's creating the value. And that is your job, and you could be an entrepreneur, and both of them have a specific risk profile as to how they generate the money. Then they would park that money somewhere, which is the left-hand side of the quadrant, and that is your passive income, which is your retirement funds extra. Now, a person who's in business and a person who's a salaried person, it's got a total, the COVID has got a total different effect on them. And today I want to focus a little bit on the businessman as well, as opposed to the salaried worker, because the salaried worker does get an income, although may limit it, but there's a bit more protection often, not always, but often. Now, what do we do with that money? And that is giving purpose to it. Now, giving purpose could be because I want to save for overseas holiday. And let's talk about the most important one. People want to know when they're financially independent, when they can retire, and what's going to happen to medical after retirement. So there are certain things that we want to do. People in the younger stage in their life, they want to give, make sure that they can provide for tertiary education. Now, those things didn't go away. It's all lifestyle events. And the right-hand side corner, right there at the bottom, is legacies. And this is typically what's happening today. This is where the Bill Gates Foundation, this is where the Rupert families, and many business people that I know that actually donated monies in order for businesses to survive and also to help the poor who doesn't have access or is losing their job. So there's the legacy component coming through. Be that as it may, every one of us is having a balancing act in life. Okay, so let's getting practical. Let's talk about the how. So we said there are two major risks in our journey through life. You either live too long or you die too soon. Now, both of them, living too long, you must have the money, because longevity is one of the greatest gifts that we received in the century, but also one of the greatest risks. So that relates to our investment. The simple question is, how did COVID-19 change this? First of all, in the case of death. Now, when I say death, it's not about you. It's about the impact also on the family that remains when you are not there. So it's about the survivor. So it's a bigger picture. And then about financial independence and the future, because investments, there was a real downturn. So let's just quickly talk about the one on death. In COVID, drafting a will, and I saw a newspaper article the other day that there are more people applying now or drafting their wills or revising their wills, because there are some real realities that are kicking in. The problem is that the master's office, there's a problem with the winding up estates, which could be a cash flow problem, and that is a backlog that's going to take place in future. But there are simple issues. How do you sign a will with social distancing? Because you need two competent witnesses that must be present at the same time, and to testify that it's your signature. So there's some practical realities, because if the will is not valid, because one disgruntled beneficiary may attack the will, we're going to have problems. So there's one practical application. Make sure that the will that is signed, that the formalities are adhered to. An electronic will is not acceptable yet in our law. If it does go through, it's simply that you have to go and fight it in court, because there are provisions in the Wills Act to do that. But the point is, you have to go and fight it to declare that will as actually valid. Now, let's work on a case study. Now, what do I want to achieve with a case study? I'm going to say, let's do a comparison in 2019, and I've taken certain assets. And this is not reflective of a typical situation. It's to illustrate my points. And that's why I chose the value of these assets to make it simple. It's definitely not relating to what is a real situation out there. So in 2019, here are the facts, and I'm going to deal with the same facts right through and say what has happened. If we assume the following: I have a primary residence of 3 million. I have a collective investment of 4 million. I've got shares of 5 million, the retirement fund 500,000, and life insurance of 5 million, and my liabilities are 700,000. Very simple. So when we look at death, there is another A on the horizon that we often don't take account of, and that is SARS. Now, SARS is also going to suffer because of this COVID. So let's have a look. First of all, what I want to do is to see what is the cash flow in my estate. So before you can draft any will, you need to look at the cash flow. So here we go. The first thing that you have to do is to calculate the capital gains tax, because capital gains tax, there's a deemed disposal of all your assets upon death. So there I would do the calculation. And if you follow my calculation without going into detail, you will see that the tax rate, which is 45%, and the capital gains tax payable is 1.260 million. That's a capital gain in the event of death, which has to be paid in cash. Then over and above, you also have to do a estate duty calculation. That's the way we do the calculation. And you see that the end result is about 2 million based on these assets that person will have to pay in the event of death. So the real issue is only this. Before I can do any planning whatsoever and talk about trust and techniques, I need to know what is the liquidity position in my estate. Now, this is important because out there, it's a possibility to reduce your premiums and to reduce your premiums on life cover. The question is, well, I want to, but how much so that I'm still okay? So in this particular case, this person took out life insurance, and you'll see that the total liquidity in the estate available would be 685,000. So he would be okay. But what happened after COVID-19. And there's the comparison. Now, I read an article yesterday, property sales obviously has slumped and the value of houses has dropped considerably. So at the moment of death, even though it's a paper loss, that paper loss is locked in for purposes of tax. So therefore, if one would do the same scenario and say the primary residence, let's assume for purposes of tax, which is the paper loss, which you're going to base your tax calculation on, has dropped to 30%. Then the value is 2.1. And so we can say for collective investments, let's work on a 30%. Now, not to say that it is 30, it could be 20, depending on portfolio, etc., etc. I'm using an example. But the shares in a business could easily be up to 50%, which makes the value from 5 million to 2.5. So if we run the calculations again on the right-hand side, I do the capital gains tax, you will see based on those figures that the tax bill is almost half. All right. If we do that for estate duty, doing exactly the same, running the calculations, you'll see that the estate duty rate has reduced to 1.4 million as opposed to over the 2 million. So we get to the engine of what we want to achieve. So in this instance, because the life insurance is 5 million, we see that we have a surplus of over 2 million. Now there's a distortion. So before people say, let's reduce my life insurance to the minimum that is allowed for the temporary period, I would say do this calculation first and say by how much can I actually reduce that? And after you have done that, there are a couple of factors you can take into account. People who have buy and sell agreements in their companies to purchase the share of another person who's taken out life cover on the life of another person, people who find them in that scenario, should really go and look and say, is this what I want? Shouldn't that life cover maybe be positioned somewhere else? The same goes for company-owned policies. If that policy is taken out to repay a capital debt, it's a non-negotiable, it's a priority, it should stay. And so we can go about. Another example would be, I do have that life cover, I want to make sure that my wife is okay. So 2 million of that life cover, if I nominate her as a beneficiary on that, the payment will be made immediately to her. It will not be part of winding up the estate. And furthermore, there will be a tax break in that I'll get a further estate duty deduction and there would be a reduction in taxes. So this is some basic example to show how you can improve your cash flow to answer that question, will I still be okay? Now let's get to the last point here. And how does it affect my investments? So financial independence is key here in my journey through life. So we all have certain goals, and to meet these goals, what we need is a certain amount of money. And you will have an investment strategy aligned to the term of when you want to achieve that financial goal, albeit to purchase a vehicle or a holiday home. Now, with this goals-based financial planning strategies aligned to investment strategies, one should go back to the drawing board and say, no, things have changed. Depending on your risk profile and where you find yourselves, say, things have changed. Now, if, for instance, in my example, I had all these goals, and this is hypothetically to illustrate the principle, that in a certain stage I want to go overseas holidays, I want to pay the children's education, because we know that's going to be in 5 and 10 years' time, purchase a vehicle, holiday home. Your first step is to move the priorities around and say, okay, given where I'm now, which is a crucial, a must, and what is a luxury? And so one can reprioritize. So there's strategy number one. And you reprioritize whether that goal is still achievable, or maybe to have monies more allocated to the children's education. If you still don't have enough, then maybe you've got to wait 1 year longer for the education. A child has got to take a gap year, learn some kind of skill so that he can support himself with pocket money. That is a possibility. And these are the type of discussions that should be taking place. I'm just going to highlight with my last slide, just on one aspect, which all of us hear in the news all the time, is that only 6% of the population can retire. And you'll see, if I can go back to my slide, I don't use the word retire. I think that since 1881, when Otto von Bismarck came with the concept of retirement. I think we should get rid of that concept, and what a better time now to start re-looking at that concept and say, is that still true? As a matter of fact, I wonder how long it will be before someone is going to take on and say, constitutionally, it's unfair to tell people to go on pension when they're 65. Because if they're still able to work, they're able to work from home, they're still productive. It has changed the arguments out there. So we're in for quite a new things. But let us just go back and talk about a strategy. So here it is. You can't retire, sir. Now, which investment should I invest? Know this, preference share. Read in the news what happened this morning about preference shares. The people who put their money in there may even lose their capital. So people are always trying to get the best return. That's not where the focus should be. It should be, what is it that I need to do to be okay? All right. So here, I don't have enough capital because I'm losing out 1, 2, 3, 4 years, contributing to a retirement fund. I can't retire. So instead of looking for a better investment out there and acting upon fear and panic and greed, let's get logical. If you can't retire, there's a simple answer. Don't retire. All right. So I can postpone the date of financial independence and work a strategy in order that I can retire at a later stage. What is the impact? Logically, let's just crunch the numbers. If I work on an assumption that the growth rate is 10% of investment, just on an average, and inflation is 6%, so that's inflation plus 4 strategy, which usually in 5 years, you've got a very high probability, given COVID and everything, that I would achieve that. I adjusted my annuity per year that you can draw down also with inflation of 6%, so I made it real into present value today. So all calculations on the present value, and I made the assumption that, let's say, retire at 60, your life expectancy is 20 years. Whatever the case may be, you can change that as you wish. But just crunch simple numbers and everything stays the same, but only the data and the timing of the event changes. So if you look at my screen, if I want to retire at the age of 60, and let's say the value of my investments are 5 million, based on the factors, I crunched the numbers, you will be entitled for annuity per annum of 350,000, which will escalate with inflation. Now, whether it's a living annuity, guaranteed annuity, Janice is going to talk about that. It doesn't really matter. This is just projections. So I assume it on 20 years, and whether you include your wife or not, all of that is part of the risk profile, but let's just keep it simple. So term is a luxury that we have because we've got a limited time on earth. So let's play with it. If I can manage to figure out a plan such as what is your passion in life, and then figure out a way how to make money out of it, and I can do that for 5 years, those funds, if I leave it intact, will grow at a growth rate of 10% in 5 years to 8 million rand. Now I've brought that back to present value and say, now I have theoretically 15 years to live. So I can live off a salary for 15 years, escalating with inflation, and today's value of 520,000 rand. If I postponed another 5 years, then the figures will change and it's 860,000. Now, which one is going to make you sleep better? Is it the 860 or the 350? Chances are it's the 520,000. So what is the action that you have to take? I know what's the problem. What I have to do for 5 years, I have to postpone my financial independence and then make a plan how I can sustain myself with whatever passion I have or whatever the case might be. But this is the effect. And I've got a goal towards that I can work. And so one can do with all the other financial goals. Now, I've tried to highlight and to explain the how of certain factors that one should consider before you start talking about a trust and a will, and etc. These are the type of fundamental basics that one has to revise, and I call it an audit of the financial plan. If it wasn't correct, fix it now. And then at least you know how to counter anything that may happen in future, because you bet, I don't think COVID like SARS and Ebola is going to be the last one. There's definitely going to be more of these, but this time around we will be better prepared. So if you have any questions, you can put them there in the question box and we can deal with that, but you can also contact your financial planner. And now what I'll do, I'll hand over the candidates to give some practical application as to some of these solutions, your investments, and the products that I spoke about. Thank you then.
Well, can you please confirm if you can see my screen?
You can see your screen, Candace.
Can see your screen.
Thank you. Thank you. Good morning, everyone. I trust you're all well and keeping safe. As with most, well, certainly myself, the lockdown has come with many challenges, and at times the uncertainty causes confusion and even some frustration. So with this in mind, I entitled and created my talk today around difficult times call for informed decisions. Difficult times call for informed decisions. Well, I don't want to expand too much on the difficult times. I think that's something that is quite clear for all of us in the situation we're in now, but informed decisions being the cornerstone of every move we make during these challenging times to ensure the best outcomes. So as one can expect, COVID-19 is currently having a negative impact on global financial markets, and the disruption caused will probably continue for a few more months to come. In hindsight, we have been impacted by global turmoil previously, and we have always recovered and will do so again. It may just take some time. Each and every individual has been affected by this turmoil, many financially, some emotionally, and even mentally, as the situation is so uncertain. It is therefore now more important than ever to remain level-headed and to continue staying on the course on the financial plans that we put together with our financial advisors. So as our clients, it is important to us that you remain informed and protected during this difficult time, and therefore the protection of financial planning is paramount. When times are tough, we all consider cutting back and reworking our budgets. When under financial strain, many of us forget the intention behind having certain policies in place, and we might even think of cancelling a policy and then have a new one put in place when things are easier and perhaps money is no longer a problem. So with this in mind, I put together my agenda. I'll be covering COVID-19 in our policies, insolvency protection strategy, and I'll also just touch on annuities. So the question arises, should I keep my life insurance policy? Besides having health changes that could affect whether you would even get life insurance in the future, or if you do, are there going to be any waiting periods put onto you, or how much would it cost you at that point? I think what is also vitally important to consider is your own risk of insolvency and the necessity to have a policy that is already in place and that is protected from attachment of creditors. But I'll go into that in a bit more detail later. But in order to answer this question of whether to keep your policies or not, it is important to remind ourselves of why we took the policy out in the first place. Every policy should have a purpose. I, for one, am not willing to pay for something that has no purpose. Errol went through a number of needs in his estate and risks like liquidity and how we can resolve that using life cover as it is paid or made available when the need arises. Instead of perhaps saving for years the shortfall required, when after one premium, a risk policy entire value is available when we require it. The cheapest money you can buy, I always say. Our policies should have names for the intended purposes. Name our policy. Each and every policy that we see on that policy schedule should have a name. Family, estate expenses, business contingent liability, and so on. Because now, while we are here, it's our jobs to provide for our families and to ensure the smooth running of our businesses. But someday, we will exchange places with our life insurance policies, and then our policies will come alive and do our jobs for us. The policy will provide for our families, and the policy will provide the liquidity to ensure that our business continues to run smoothly for our dependents. Whenever the upkeep of our policies feels burdensome, which often does, considering the times we're in, and we look at all of our expenses and much the first thing we can cut off, I think it's important to remind ourselves of the intention behind those policies and whether the needs that they were put in to fulfill has fallen away. Because if the answer to that question is no, and those needs are still very prevalent, then it's absolutely paramount to keep those policies in place. Due to the COVID-19 pandemic, the insurance companies had to limit their offerings like retrenchment protector, business overhead protection, loan protection, and so on. So if you didn't already have these benefits in place, you cannot get them now. New life covers have been limited in their offerings due to nurses being unable to go out and see clients and do all of the necessary medicals that's required. Therefore, if you did already have this cover in place, you're in a much more fortunate position. If not, you're either limited or you have to perhaps wait for the pandemic to stabilize to obtain certain benefits. Hopefully with our president's speech last night, we're now moving to level 3 of the lockdown, it might be possible. But the option of not being able to is very scary. Another important aspect that I brought up was to always be aware of the credits protection that you have for your policies. So Section 63 of the Long-Term Insurance Act, not to be too technical or too legal, but this section provides protection of risk policies like life cover, even your endowments, because even though an endowment is an investment, it has a life cover element. So these policies can be protected from creditors if it meets certain requirements. So the requirement is that the policy has to be enforced for 3 years. If so, the full policy benefit is protected from creditors. If policies are paid directly to a beneficiary, they are automatically protected, except if your beneficiary is a spouse where he or she is married in community or property, because once you're married in community or property, then your debts are then shared jointly and you're both jointly and severally liable for those debts. And the funds can be attached for the deceased debt. Or another exception is where the beneficiary is someone that has signed surety for a debt. And based on the suretyship, the creditor can then attach funds that have been paid out to settle these debts. So what protection am I talking about, and when would it benefit you? So there are 2 incidents when the policy is protected. Number 1, when the life assured is alive. So if you have an endowment that is protected and you find yourself in a difficult financial position, even insolvency, the creditors cannot attach this investment. Even if while in insolvency you take an advance, these funds that you received from the endowment are protected, and they are protected for a period of 5 years. Whatever you purchase with those funds are also covered by this protection. So if it's used to purchase an asset, an immovable property, if these funds had come from an endowment that are protected under Section 63 because they were 3 years old before the attachment or the insolvency arose, whatever you purchase with these funds thereafter are further protected, and this is protected for a period of 5 years. So endowments are an excellent vehicle to utilize at these uncertain times. The second instance would be on death. So if the policy is protected and pays into an estate that is overly indebted or is insolvent, it will be protected from the estate debts and will be paid to the beneficiaries as per the will. The policy has to be enforced for at least 3 years, and it's very important to understand in terms of replacing the policy by another insurance company, because as soon as the same policy is replaced by another policy, by a different insurance company, it stops the accumulated period on that policy, the 3 years that I'm going through, and then starts afresh when a new policy is put in place. So let me go through some practical examples. Example, Mr. B dies insolvent and is survived by his wife, Mrs. B, and son, James. An endowment he has been in place for a period of 8 years for the value of 2.8 million and has recently ceded this to the bank as security for a flat that Mr. B has purchased. The outstanding bond on the flat is 1.7 million and his son James is a nominated beneficiary. We have a life policy number 2 where this has been in place for a period for 1.5 years with a value of 5 million with the estate as the beneficiary. Then we have policy 3, a life policy that has been enforced for 6 years, valued at 3.5 million, and he has nominated his disabled sister Susan as a 50% beneficiary of this policy, and the balance will pay into his estate. This policy so the first policy, policy number 1, has been in place for a period of 8 years, therefore it has not reached the 3-year requirement, and this policy is fully protected. As it is ceded, the policy will be paid over to the bank. The bank will then settle the outstanding balance of 1.1 million, and the difference will be paid over to the deceased estate. Now, if this policy was not protected, whatever debts were liable in that estate, these proceeds would be used to settle those debts. But because this policy is protected, this policy proceeds of the difference of 1.1 million will then go to the deceased beneficiaries, and the executor can pay that out to the necessary beneficiary. The second example, where we had the policy that was only 1.5 years and was payable into the estate, because this policy is still too young and has not reached a minimum of 3 years, this policy then is not protected by Section 63 and will be fully available for any debts in the insolvent deceased estate. Policy number 3, this policy has been enforced for a period of 6 years, so it's over the required period of 3 years. Half was to be paid to the sister and the other half was to be paid into the estate. Now, because half of the beneficiaries to be paid to an independent beneficiary, this is automatically protected. So even if it wasn't over 3 years, this part of the proceeds would have been protected because the sister is an independent beneficiary. However, because there's a balance that's been paid into the estate, and this could have been opened up to the estate for estate debts. But because it's over a period of 3 years, this policy then is protected by Section 63, and the creditors cannot attach this policy and will go towards the deceased beneficiaries or to the deceased dependents, so this will be the wife and Mrs. B and the son James. So my last slide, just to end off today, regarding Errol's discussion on retirement, I thought I'll also just discuss a bit on annuities. So to the end, I will just go through what is required at retirement. So when you have a retirement annuity, at that stage when you retire, you have an option of either purchasing an annuity with the entire amount, or you can be allowed to take a 1/3 lump sum in cash. Now, the balance that you utilize to purchase an annuity, this is an income that you're providing for yourself, because now you're probably no longer able to work, you have retired, you're no longer receiving a salary, or whatever other income you were receiving. Because that has now ended, this annuity is providing you an opportunity to purchase an income for yourself. There are 2 types of annuities that are available to us, and this is your living annuity and your life annuity. It's absolutely important to be informed of what both types of annuities offer, what are the risks, what are the protections, so that you can make an informed decision if you are reaching retirement as to what you can and what you cannot do. So just quickly, a life annuity creates certainty, and you are guaranteed an income and protected from risks like living too long, as Errol explained. However, dying too soon is also seen as a risk, and your capital could be lost, or most of it could be lost, as you do not get to utilize most of it. Then we have a living annuity. So a living annuity, you get more flexibility in terms of your income, your drawdown, and portfolio changes. You also have the option to change your mind in the future. So at Liberty, I know we have the risk enabler that allows you to invest in a growth-oriented portfolio while being protected by a safety net of a guarantee, which your financial advisor can tell you more about. So if you are nearing retirement, it's important to understand what risk you are concerned about and what risk you're not so much concerned about, which is something that you wouldn't need to consider too much. Not everyone has the same risk applicable to themselves. So perhaps you could look at looking at a combination of both to provide you the best of both worlds. During these uncertain times, it's always best to know that you're covered in each and every aspect that could possibly affect you. So it's very important to be informed, very important to ask these questions to make sure that you're covered in any aspects that can happen in the future. We don't have control, we don't have a magic ball that we can look in and say, this is how things will end, or this is how things are probably going to occur. At least in this way, being informed, you can make sure you have products or policies in place that can cover you in each and every aspect. Okay, so that's it for me on my side. I'm now going to hand over to Errol just to go through any questions that might have come through. Thank you once again for your time, and stay safe.
Okay, well, thank you, Candice. Yeah, I've got 3 questions, I think, that one can discuss that is relevant. So I suggest that don't mute and stay online. The first question is the rate of estate duty 20%. Did that not increase? And yes, it's absolutely correct. The estate duty rate did increase, and that was after the Davis Tax Committee made some recommendations. And it was about, I think, Candice, about 2 years ago, that for estates over 30 million, the rate is about 25%. I think what also with the Davis Tax Committee, they recommended that the assets, like the example I used where you nominate your wife as a beneficiary of a policy, whatever you bequeath to your spouse, there will be no estate duty or capital gains tax. So in my examples that I used, if that person would have bequeathed everything to his spouse, there would be no estate duty or capital gains tax, but then it would be in the event of her death. So obviously that is another strategy that one can look at. And then I would say always remember all the funds in the retirement, all retirement funds, be it a retirement annuity, provident fund, or pension fund, all of them actually escapes estate duty. So a lot more is to be said about the estate duty rate and the actual implication. But I just presented the scenario, perhaps I should say, almost a worst case scenario. So, but when you crunch the numbers, yours may be better. And then here, there's another one. We didn't talk about trust, but maybe I mentioned, I can't remember. But with the trust, you can still save on estate duty, individual trust. It's still a viable option. Yeah, of course, it's a viable option, because the trust, as it is today, still don't pay estate duty. There were anti-avoidance provisions because of the creation of loan accounts not charging interest. But many people have got their assets locked up in a trust. And as a matter of fact, upon death, there's no CGT and there's no estate duty payable within that trust. These are the current laws. It doesn't mean that we must move our assets now to a trust, because the planning of that is limited. But if you're going to dispose of those assets in trust, there could be a higher CGT. And these are all the factors that one has to consider. Maybe two aspects I can mention. You can nominate a policy to a trust, because what do? You create a liquidity in the trust, which is outside your estate, or you can nominate to your spouse. If you would nominate to your spouse, then there would be a deduction for estate duty and estate duty relief. But it all depends what is it that you want. Maybe you don't want to give it to your spouse or the full amount because you want to safeguard for children, etc. These are things that you can discuss with your with your financial planner. And then I think the last one, Candice, help me out here. You spoke about the living annuity and the guaranteed life annuity. And I think the question that relates to that, and I think many people, or most people, I would say, went for the living annuity. With other words, as you explained, they took on the investment risk, and now the funds has dropped. And there's so much being made at what I can do. But one thing that people don't often realize is that once you're in a compulsory post-retirement annuity, which is a compulsory annuity, you have very few options available. In that you are locked into that. But there is one exception, and just help me on this. If you move from a living annuity into a life annuity, you do have that option, and I think this is what you play.
Absolutely.
Maybe just a little bit of detail in that, and that's the only questions that I have.
Absolutely. So in terms of the living annuity, once you are in a living annuity, there is some flexibility in terms of whether you want to move your capital, if you change your mind a bit later, and then later on you're not too happy the way markets are doing and you want more of that security. If you are in a living annuity, you do have the option of moving into a life annuity, which is an annuity where the insurance company gathers more of the risk if the markets are not doing well, and you're more secure or certain in terms of the income that you'll be able to receive in the life annuity. However, if you are in a life annuity already, at that point, the markets are now doing well, and you're thinking, I actually would have received a much better, growth if I was in a living annuity. Unfortunately, the restriction is from a life annuity into a living annuity. That will not be allowed.
Yeah, that is correct. Well, that is the only questions that we have. And Katiwe, over to you.
Thank you so much, Errol. Thank you so much, Candice. Very informative. Ladies and gentlemen, thank you for your time. Should you have any further questions or need further engagement, please don't hesitate to contact your relationship manager or your financial planner or business managers. They're actually listening in on this session as well and are ready and waiting for your call. We thank you very much, and we'll see you for the next webinar, should we have one. Look out for the invite. We wish you and your families well, and stay safe. Thank you, Candice. Thank you, Errol.
Pleasure. Thanks, Etibe.
Thank you.